Good evening. We begin tonight with a significant development in the silver futures market, where the price of silver crossed $89 per ounce during Tuesday's session, capping a rally of more than 7% in under 36 hours. Curious, what makes this move particularly notable, according to market analysts tracking institutional order flow, is not simply the magnitude of the price change, but the mechanism driving it. Silver was trading at $83.70 on Monday morning. By the time the New York futures session closed on Tuesday, the metal had climbed to $89.12. Surprised, that represents a substantial recovery executed within a compressed time frame, and analysts are pointing to the behavior of high-frequency algorithmic trading systems as the primary driver of that move. High-frequency trading firms, which are reported to account for over 60% of all daily volume in the futures market, operate through computer-based algorithms rather than human traders making manual buy and sell decisions. These systems are programmed to identify momentum signals, execute trades at microsecond speed, and respond to technical indicators such as moving averages, volume profiles, and historical price levels. According to analysts following Tuesday's session, those systems, which had been positioned on the short side of silver as recently as Monday morning, reversed their directional bias and began accumulating long positions as a series of technical signals shifted in silver's favor. The catalyst for that reversal, as identified by market observers, was a breakdown in the US dollar index, known as the DXY. The index, which measures the dollar's value against a basket of foreign currencies, broke below the 99 support level on Monday afternoon and continued declining through 98.8, 98.5, and 98.2. That movement generated conflicting signals within the algorithms that had been shorting silver based on its correlation to crude oil, which had itself declined from $82 to $71 per barrel following reports of a potential Middle East diplomatic development. To understand the full significance of Tuesday's silver rally, it is necessary to examine the sequence of events that unfolded across Monday and Tuesday's trading sessions, and specifically, the mechanics of how algorithmic systems transitioned from aggressive short positioning to aggressive long positioning within a period of less than 48 hours. On Monday morning, silver was sitting at $83.70 per ounce. The broader commodity complex was under pressure. Crude oil had declined from $82 to $71 per barrel, and the correlation models embedded within institutional trading algorithms were generating signals that silver should follow oil lower. Those systems began selling. Silver was pushed down to $83.20, then to $83 flat. For approximately 6 hours on Monday, the price held in that range, with analysts noting the possibility of a retest of the low 80s or a potential break below $80 if selling pressure continued to build. However, the algorithms had not accounted for a concurrent development in the currency market. As the US dollar index broke below 99 and continued declining, the systems that had been shorting silver based on the oil correlation began receiving conflicting inputs from their currency models. The reason for that conflict lies in a fundamental distinction between how oil and silver respond to macroeconomic conditions. Oil is classified primarily as a geopolitical commodity, one that moves in response to supply disruptions and production decisions. Silver, by contrast, carries characteristics of a monetary metal, one that historically moves inversely to the US dollar. When the dollar declines, silver tends to rally, and that inverse relationship is embedded in the historical correlation data that institutional algorithms are programmed to reference. As the dollar continued to weaken on Monday afternoon, the short covering process began. Algorithms that had sold silver contracts at $83 started buying those contracts back. That buying activity created upward price pressure, pushing silver from $83.20 to $83.60 and then to $84 flat. At that point, a series of technical indicators shifted. Momentum readings turned positive. Moving averages crossed in a bullish direction. The MACD indicator turned positive, and according to analysts tracking the session, every high-frequency trading system monitoring those indicators received the same directional signal simultaneously, that the trend had reversed and that the appropriate programmatic response was to buy. What followed was described as a classic short covering sequence. Algorithms that had been holding short positions found themselves on the losing side of a rising market. Those systems were programmed with stop-loss orders, automatic instructions to close losing positions when the price moves against them by a defined percentage. As silver crossed $85 and continued climbing, those stop-loss orders began triggering in sequence. Each round of stop-loss triggered buying. That buying pushed the price higher. Higher prices triggered additional stop-loss orders from other short-positioned algorithms. Those orders generated more buying pressure. The cycle repeated, accelerating the upward move through $86, $87, and ultimately to $89.12 by the close of the New York session on Tuesday. A gain of over 7% from Monday's lows, achieved while crude oil remained stationary at $71 per barrel. Analysts describe this dynamic as short covering and identify it as one of the most powerful accelerants for a market rally, precisely because it converts sellers into buyers. The same algorithmic systems that were applying downward pressure on silver's price on Monday morning were generating upward pressure by Tuesday afternoon, not as a result of any change in their fundamental programming, but as a direct consequence of momentum signals reversing and stop-loss protocols executing automatically. Continuing our coverage, we turn now to the specific technical level that analysts have identified as the primary programmatic target for the institutional systems currently active in the silver market. That level is $95.86. The most recent structural high recorded on the silver chart reached on March 3rd before the metal pulled back to $83. According to analysts, every momentum-based algorithmic trading system operating in the institutional space has that level marked within its decision framework as the next major resistance zone to be tested. The significance of previous structural highs in algorithmic trading systems stems from their role as programmatic profit-taking reference points. Traders who purchased silver between $90 and $95 during the prior rally are now in a position to exit at a gain as price returns to that range. Simultaneously, algorithmic systems are programmed to identify those levels automatically by scanning historical chart data and to mark them as zones where selling pressure from other algorithms is expected to materialize. The result, according to analysts, is a self-reinforcing dynamic in which the approach of a key resistance level draws increasing volume and algorithmic attention, which in turn accelerates the price move toward that level. If silver were to achieve a daily close above $95.86 on strong volume, analysts identify the next significant historical resistance at $105, described as the peak reached during what is referred to as the COMEX inventory crisis of 2024. between $95.86 and $105. The chart is described as containing no major previous highs or consolidation zones that would represent programmatic resistance for the algorithmic systems. Analysts also note that at the time of Tuesday's session, the COMEX registered silver inventory, the physical metal available for delivery to settle futures contracts, was sitting at multi-year lows, and physical dealer premiums were reported at 15 to 20% above the spot price for immediate delivery. As we bring together the key developments from Tuesday's session and the broader context surrounding silver's recent price behavior, we turn now to the macroeconomic backdrop that analysts say is underpinning the current market environment, and to the historical precedents being cited in assessments of the present setup. On the fundamental side, analysts tracking the precious metals market are pointing to several conditions that they describe as structurally significant. The U.S. national debt currently stands at $41 trillion, growing at a reported rate of $2 trillion per year. The federal deficit is reported at 8% of gross domestic product. The Federal Reserve, according to analysts, faces a policy constraint in which raising interest rates risks destabilizing the Treasury market, while lowering rates risks accelerating dollar depreciation. The U.S. dollar index has broken below the 99 support level and is described as trending toward the mid-90s, a range that analysts note preceded the precious metals rally observed in 2020. Physical silver premiums at dealers are currently reported at 15 to 20% above the spot price for immediate delivery. And COMEX registered inventories are described as sitting at multi-year lows, with refiners reported to be unable to keep pace with physical demand. For historical context, analysts are drawing comparisons to 3 prior episodes in which algorithmic momentum trading played a significant role in precious metals price movements. The first is March of 2020, when gold was trading at approximately $1,500 per ounce. Following the onset of the COVID-19 pandemic and a period of significant Federal Reserve monetary expansion, the U.S. dollar index began declining and algorithmic systems shifted to bullish positioning. Gold moved from $1,500 to $2,000 in under 4 months, a gain of approximately 33% in 16 weeks. Silver during the same period moved from $12 to $30 in 5 months. The second comparison point is 2011, when silver advanced from $18 to $49 per ounce in under 1 year. That move is attributed to a combination of algorithmic momentum trading, dollar weakness, and a global sovereign debt crisis. That rally was ultimately interrupted when the CME raised margin requirements 5 times over a 2-week period. Even following that decline, silver stabilized at $26, still representing a significant gain from the $18 entry point. The third reference point is the broader progression from October of 2024 through the present, during which silver has advanced from levels in the upper 20s to its current price of $89. Within Tuesday's specific session, analysts identified 4 data points they describe as the key indicators to monitor as silver approaches the $95.86 resistance level. The first is the U.S. dollar index. A continued decline below 98 is described as a positive signal for algorithmic buying to continue. A recovery back above 99 is identified as a potential cause for consolidation. The second indicator is futures trading volume. Elevated and increasing volume as silver approaches 95.86 is described as confirmation that algorithmic buying momentum remains intact. Declining volume near that level is identified as a potential signal of caution among the systems. The third indicator is physical dealer premiums. A further increase from the current 15 to 20% range toward 25% is described as evidence of tightening physical supply and a widening divergence between paper and physical pricing. The fourth indicator is open interest in the futures market. Rising open interest alongside rising prices is described as evidence of new long positions being established. Declining open interest alongside rising prices is identified as a signal that the rally is being driven primarily by short covering, which may have a more limited duration. To summarize the key facts from tonight's coverage, silver closed Tuesday's New York session at $89.12 per ounce, up over 7% from Monday's low of $83.20, a move achieved within approximately 36 hours. Crude oil remained at $71 per barrel throughout that same period, representing a decoupling of silver from the oil correlation that had governed its behavior on Monday morning. The US dollar index broke below 99 support on Monday afternoon and continued declining. High-frequency trading algorithms, reported to account for over 60% of daily futures volume, are identified as having reversed from short to long positioning during this period, driven by momentum signal reversals and stop-loss execution sequences. The most recent structural high on the silver chart is $95.86, recorded on March 3rd, and analysts identify this level as the primary programmatic target for the institutional systems currently active in the market. The U.S. national debt stands at $41 trillion. Physical dealer premiums are reported at 15 to 20% above spot, and COMEX registered inventories are described as being at multi-year lows. These are the conditions and the market dynamics that defined Tuesday, March 10th, 2026, in the silver futures market. We will continue to monitor developments as Asian trading sessions progress through the overnight hours, and will bring you any material updates as they become available. For all of us here, thank you for watching. Stay informed and good night.